Welcome everyone to a new ATFX video. My name is Gonzalo Canete and I'm here to share with you a recap of the week and the main important events that affect the markets this week, closing this week. Today is Friday. By the time you see this video, you probably are watching the video next week just to get that recap done and review what was the main events during this week, what mainly happened, and how these events affect the market. This week I was actually starting super softly. There was not many micro data to get published, not many impacting news so far. But the end of the week, we got the PCE, the new inflation rate published by the Federal Reserve, which is it was called to confirm or actually rectify the last 2 weeks ago inflation rate we received from the United States. If you remember well, 2 weeks ago, that inflation rate was published. It was actually higher than expected, and therefore was scaring the market, because considering that inflation rate coming back in United States, the main fear of the investor, it was, well, if the inflation is here, obviously the Federal Reserve is not going to cut interest rates. So therefore, this week PCE, it was one of the most expected data or results for the US economy, and also for those ones who follow the biggest stock exchange in the world, which is New York, Wall Street, and the reaction of the equity, SP 500, and mainly all of them there. Let's take a look on the charts. And first of all, let me remind you one more time that every single morning you got published on our blog, ATFX Connect website. So you can go just to atfxconnect.com. You can also access to the blog Market Snacks, and you're gonna get a fresh update of the last 24 hours, an interpretation, certain targets, certain goals, expectations we got on the market. Everything is there, so you can just take a look there. Even if you want, you can also contact me by email and request to get the newsletter, and I can just link it to my newsletter. So you got my email right there. And if you want to just receive on your email the last updates, I can just add you my newsletter, and that's completely fine. Now, coming back to the screen, let's take a look at what was the main events. So we got the PCE, and we also got the GDP review of the Q4 for United States. It was the second review with more data to see if actually the economy in the United States closed the year 2023 with a growth rate of 3.3% on Q4, which was what was the number we got it. And the review this week was actually giving us a correction of 0.1% of the growth rate. So it was 3.2%. That's good, actually. Even if the growth rate is getting weaker or smaller than expected, it means that actually Federal Reserve got a new, let's say, a new excuse, a new point to cut interest rates, which is what Wall Street is expecting. So bad data, bad macroeconomic data means positive reaction for the market. Keep that in mind. If the unemployment, on next week, for example, on Friday, we're going to see the non-farm payrolls. If that non-farm payrolls unemployment rate is actually rising, you will see that the reaction by the equity market is actually positive, because it means that the finally Federal Reserve got confirmed a slowdown on the US economy, and therefore the interest rate cut is actually a good step to take in order to stimulate the economy. Otherwise, if the numbers are good for non-farm payrolls unemployment rate, it's actually low unemployment rate, low non-farm payrolls, high non-farm payrolls. It means actually that the things are, the economy in the United States is still stronger. It's actually unemployment rate right now at the moment is below 3.8%, 4% mainly, which means like the labor market is strong, is still strong in the United States. And that's the main concern for Federal Reserve, because Federal Reserve is worried about the fact that if unemployment rate is low, if labor market is strong in the United States, there is probably a good high pressure on salaries, and therefore inflation, which is mainly coming, the core inflation is coming from services, and services is caused mainly by salaries. So it's not about capital, it's about labor force, and therefore salaries. And they expect that probably if the inflation is mainly composed by rise on the services prices, it means then the labor market is it's a big influence on the inflation rate at the end of the day. We got a dollar index on the screen. Let's go step by step so we can review everything. We got the review from PCE inflation, which it was actually in line with expectations. It fell 0.1%, given the annual one in 2.4%. The level increased by monthly. It was 0.4% month to month compared with the previous period, which is still an inflation rising, 0.4% low, but it's still rising. But again, it was in line with the general expectation, so therefore it didn't cause many impact on the market. By the time I was doing the report, we were just mentioned here that the response by dollar, the DXY index, it was positive. Right now we see that actually the price is pulling back down again. So let's move to 4 hours candle so you will see what I mean. But it's moving back again to the main points of the we call basically the breakout area or zone, which is this neckline that eventually could pull the price up to 107 points, 107.50 points, was that's the target. We also got the neckline here working as a kind of support. We got the 200 moving average period and 55 periods moving average too also here. So these ones are working as a support, and therefore we could expect that if this area of price 103, 103.50 points in dollar index resist and hold the price there, there is still a chance that the bullish rally could start in dollar again, moving to 108, in which case euro dollar actually could drop back again to 105, which if you take a look on long term on this chart, you will understand what I mean. Take a look, it's beautiful. And as you can see, it's so clear that historically, since 2008, we have seen 1, 2, 3, 4, 5 times. This is the 5th occasion when the euro dollar could actually pull back again down. And in this case, this drop could actually take us even farther than the last time and put the euro dollar below the parity, but even to levels like a 0.95, 0.92. Very interesting. So keep an eye on euro dollar in relation with the evolution of the dollar. From European perspective, makes sense because today we got in the calendar the PMI from Europe. Most of them, as you can see here, are 44, 48, 47, 42. Everything below 50 means contraction, economical contraction. And as you can see, only with a few exceptions, which is the Spanish economy, Greece economy, and Norway, these 3 economies actually publish positive PMI. But the rest of them, take a look at the case of Germany, which is the industry, the main industry of Europe, is giving a German manufacturing PMI of 42.5. It's a disaster. It's better than expected, but it's still a disaster because it's below 50 and below the previous one, which was 45.5%, which is so low for an economy that actually is mainly the main core of the economy is the industry. China, we got also the PMI from China. Let's take a look on the calendar. Everything is on the summary. If you want to go to details and get more explanations about everything, I just make here a few comments and how the Chinese economy is actually linked to regional economies and so on. But let's take a look quickly here of PMI. As you can see, it was not bad because it's 50.9% of manufacturing, non-manufacturing services 51.4%. Still expansion, but it brings some concerns. As you can even read here, if you want to go to details, you will see that actually we say here the PMI manufacturing dropped to 40.92% in January from 49.1% on February. The decline in the output component, it was in line with a median expectation of 49.1% by Reuters poll. But also it's giving us one of the reasons why it could even get weaker than expected. It was like since this last year Lunar New Year holidays, so just bank holidays in China and in all the economies around China, it could also contribute. The seasonal considerations play a part in some of weakening. So maybe that will one of the reasons, because publics mainly stopped. People just went home to celebrate the new year, and it was taking few days off, not only one, few days off. So that could affect actually. What else? We also mentioned non-manufacturing PMI was actually good, 51%. We already have seen the results already. China, this is very interesting. Next week on Tuesday, we're going to see what is the official growth rate for China economy. Chinese economy going to publish, Communist Party going to publish the target, the goal for this year. The expectation around 5%. Last year was 5%. But probably what we're going to see is like, I believe, and even many other analysts, if you start to try to find this, the opinion of everyone, I have seen even projections of the growth rate of China, not now, but even last year, saying that the coming 5 years going to be around 4%, 4.2, 4.5% growth rate, which is something that probably will happen because in 2023, the growth rate was around 5%, and still it was given during the year certain fluctuations on the growth rate, indicating that it was not so easy to reach the 5% of growth rate in China, and therefore we need to also follow up this. So you got, what was this? I was mentioned here, the growth rate. Oh yeah, analysts predict Beijing will stick to its 5% growth. I don't think so. We will see, because if they say 5%, it means they need to convince the world that they're growing at 5%. And right now we got many different indicators that show that the economy in China is slowing down. Even this week on Wednesday, I bring to you in the comments on the report, one of the topics, it was related with real estate in China. Country Garden, one of the companies quoting or listed in Hang Seng in Hong Kong, was actually going to liquidation or making a default of $200 million, something like that. You can take a look deeply in the story of the company, but mainly was dropping down the Hang Seng and also increasing the concerns related with real estate in China. Japan, we got, Taiwan also. Taiwan likewise show a somewhat faster rate of reduction in industry activity. Japan, we got also the PMIs from Japan published last night, during the night between Thursday to Friday, which is Friday morning for Asia. Indicates the factory activity is declining its quickest rate in over 3 years, suggesting the Japanese manufacturing sector operating conditions will continue to deteriorate for another month. It's also interesting because dollar yen is in an amazing situation right now. We are really close to the top records of dollar yen registered in the last 30 years, more than 30 years. We are getting close to 160 yens per dollar yen 160, which is exactly the levels reached in April, May of 1990. It's incredible, and we are getting close to those levels now, right now. And why is important this? Because Bank of Japan is actually in a very, very difficult, hard situation. Take a look on this. Challenge in trying to pull out the ultra easy monetary policy has been made more difficult by worrying new data that indicates the weakness in Japan during the second half of the year. Which means, if the Japanese economy is getting weaker, how the Bank of Japan gonna actually change the monetary policies and reduce the liquidity of yen in the interbank system? They probably, if the economy is getting slow and they got certain declines on the industrial activity in Japan, it means that they probably need a stimulus more than a contraction on the monetary offer. But still, the exchange dollar yen is going to one of the worst situations in the last 30 years. Every single thing that Japan is buying out there is more expensive because it's quoted in dollars. So energy mainly in the trade balance of Japan is going to start to be so heavy, but that's fine. I mean, if they can keep play with the monetary offer like have been done for the last 10, 20 years, they can survive. Let's see how they do this, because it's getting harder and harder the game, but they're still playing with the machine. Japan, just a reminder, Japan is still the third biggest economy in the world, and therefore whatever happens with the Japanese economy can affect the Chinese economy. So the first economy is United States, the second one is China, and the third one is Japan. So China and Japan is the Asian bloc. If something happens in Asia, believe me, it's gonna affect the whole worldwide economy. South Korea and India, thanks God, so better numbers. The PMI in both countries was positive. The reaction was good. So therefore, not everything is going bad. From Europe, Asia, it was bad news, bad results, but after all, everything is fine in terms of China and India and South Korea. Now let's take a look to SP500. Let's take a quick look on the market, equity market. First of all, we are taking we're gonna keep an eye on SP500. As you can see, I shared this chart in social networks. You can just follow ATFX Connect on X, and you will find these charts too. I'm just do a projection since the end of the year, December, just to try to monitorize how this range is reproduced and projected one and one over again, over and over again. And we can see that right now it seems to be a kind of resistance in 5,120 points. But if we also let me have some lines here to follow the extended left middle line. That's it. That's what I want. Middle line. I want to take a look closer. What was the levels to follow up? And let me see. That's fine. Good. So the next goal probably is 5,150, 55 points in SP500. If it's continue making this kind of symmetry, as you can see, every single run seems to be more or less the same size. So the next one will be 5,150 points, 5,230 points if it's keep rising. In the other hand, we got Nasdaq getting close to 18,000. Look, it's already passing 18,000. It's amazing. 18,177 points. Almost 1% up the market right now, Friday evening. Russell 2000 is taking time to go there. Still far away from the top records. That's the main difference. Russell 2000 seems to be more conservative than Nasdaq or SP500. And again, it's composed by micro, small, middle caps in the United States, and therefore reflects mirror more, how we can say, it mirrors the economy of the United States from more real view than the SP500 or Nasdaq. In Europe, we got DAX 40 keep rising to the levels of 18,000 points. It seems to be, it doesn't matter how the economy is going in Germany. The market is rising and rising and rising and rising, regardless how bad the things are getting in Germany. So that's why I believe the German stock exchange, the German market, the German assets are mainly supported by the Central Bank of Europe somehow, or by big hands that they are keeping the market up. Because obviously, rationally speaking, take a look on long term, you will never probably buy in a market showing this trend. You see, the risk of correction on the market and fall all the way down is so high to be right now long on this asset. Nikkei, it was doing so well too, with new top records, maximum top records. We got Hang Seng from Hong Kong trying to recover from the last drops. Let's take a look daily, and you will see that it's taking step by step, but trying to conquer certain levels like the moving average of 55, probably attacking the moving average of 200 if the things are going well. China is still announcing many stimulus from a fiscal perspective, monetary perspective also, reducing the cash coefficient. We got also Shanghai Composite doing something really similar to Nasdaq, to Hang Seng. But in long term, this is the picture you need to keep in mind. The Chinese stocks are weak, as you can see. We are not. It's completely different. It's actually the opposite situation of US stocks. Chinese stocks dropped a lot for the last year, and the last few months has been a disaster. So that's why they still fighting to recover. And keep in mind what I told you. Country Garden, they go to default a few days ago, and they are caught in a Hang Seng index. So that's mainly why we have seen this. Finally, let's close with, we have seen dollar index here. This is the pattern we were just following up in dollar index, the one I was mentioned on the report, which it was the main supports, and maybe complete the figure going to 108, then euro dollar dropping. I think we mentioned this already. Oil is rising 80.35. There is pending, if I'm not wrong, I believe this next week on March, first week of March, OPEC Plus, they're going to have a meeting. They're going to discuss the global and also make a deal on the global production, synchronize the production globally of these main producers of oil. And therefore, they're going to probably try to pull the price up again by reducing the production as they did last year. Let's see how is the reaction. But so far, we can see clearly certain levels, $83 per barrel in Brent oil, and also 85, 86 here. And in long term, you got here a very bearish figure. Let me show you, which is a shoulder head shoulder that it seems to be getting formed here. And in case that this area 68, 72 to 68 is breaking down, it can pull all the price down. Situations in which context we can expect this, probably if it's confirmed by different sources, a global recession, which means a slowdown in the Chinese economy, US economy, and European economy as well. In terms of gold, it's rising right now, which means like we probably are facing the drop on dollar index, which is right here. Exactly, dollar index is in red right now, and gold is rising. I believe we need to keep an eye also in gold. Regardless this movement, the main feeling I got it is if dollar is going to 108, 107.50 points, which is our target, it means then the gold probably is going to start to quote here. Unless something happens from a geopolitical perspective, Middle East, Ukrainian war, something start to go or escalate to a worse scenario. And in that case, gold is going to rise like a rocket because it's the safe haven, the main safe haven for the more traditional funds. In the other hand, the other safe haven, digital safe haven that is working really well and amazing results is Bitcoin rising to a new top record, 61, and the maximum levels reached it was $64,000 per Bitcoin. Amazing. It's getting closer and closer to the top record registry in 2021. So let's see how it's going, the evolution. I think that's all. This is the summary for the week, the recap for you starting the week now. You got a whole picture of what is going on. And if you want to request anything in particular, please keep in mind you can contact me through my email right there. And you can request a specific assets, any particular webinar, any topic, completely free. Or you can also request to be had on our newsletter from ATFX Connect and or ATFX Global. Okay. Take care and have a beautiful day. Bye bye. Ciao.